Fiat's tokenization efforts are starting to stabilize with the Genius Act. I think you now have the regulatory clarity as well. When these things start gaining traction, they just grow exponentially. I think the biggest product market fit for tokenization has been fiat. Stablecoins are the new meme coins.
So how do you see the compliance side of it?
Can we achieve the same kind of network effect with 1.7 million users through this 170,000 users? That's the biggest experiment.
Let's say 5 years down the line, where do you see Kamino heading the RWA ecosystem?
It is going to be a big, huge journey that we are working on.
Good morning, everyone. Today, we have with us the head of institutional sales at Kamino Finance, Mr. Arun Krishnakumar, and I'm Prashant Jha, a reporter at CCN. And we will be discussing the evolving role of decentralized finance in the latest crypto trend, the real world asset tokenization, RWA. So yeah, to begin with, I'll ask you about how do you see the RWA tokenization trend in 2024 compared to 2023? Since we had this, earlier we used to call it securities tokenization back in like 2020, 2021, but now it has been evolved into a use case of its own. And we have seen billions in US treasuries. Some firms are even tokenizing real estate. So how do you see the evolution over the year?
Yeah, I think to start with, we all get into the moment we say tokenization, we all get into the asset classes like real estate, stocks and all that. I think the biggest product market fit for tokenization has been fiat. And because of that, what you're seeing, the stablecoin market is booming. And now it's, I think I remember this, I think it was in one of the consensus panels where I mentioned that stablecoins are the new meme coins. Effectively what is happening is every single institutional issuer, and not even institutional, half institutional issuer could potentially launch a stablecoin. And that to me is the biggest, best product market fit for this industry. And as fiat's tokenization efforts are starting to stabilize with these, with the Genius Act passed in the US, I think you now have the regulatory clarity as well. I mean, if US has regulatory clarity, the entire world in some sense has regulatory clarity. And once that has happened, it now kind of is now looking at, okay, how do we then replicate this success across other asset classes? And bringing stablecoin volumes in the hundreds of billions. It's at about 300 billion, if I'm right, give or take, today in terms of stablecoin market cap on chain. Bringing that to on-chain trading and really kind of holding crypto and TradFi assets and being able to kind of go in and out of it with stable coins, I think that should slowly start building more narratives for tokenization and tokenization of other asset classes. But again, one thing I would say is, yeah, we are in a much, much better place in most sense that we can think of from where we were in 23 and 24. I don't think we were anywhere close in 2023. That's what they say, right? Sometimes nothing happens in years, and then sometimes years happen in weeks, right? So that's kind of what has happened in the last maybe 6 months or so. But I think once it starts maturing, there's quite a lot still to be done. So in so many different ways, and I'm happy to expand on that. But when these things start gaining traction, they just grow exponentially.
So as you mentioned that fiats are some of the biggest use cases for tokenization at the moment. But let's say apart from fiat, fiat will be used for cross-border transaction, yields and all. But apart from fiat, where do you see other TradFi sectors where tokenization could bring things on chain? For a firm like Kamino, where do you focus more right now? Which sector are you focusing at?
Sure, I can give you a couple of pointers there. It is not just like a Kamino's decision, right? We don't decide which assets to tokenize. It's really the market telling us where the demand is. We do see like two different audiences in some sense, right? So if I'm serving a hedge fund, and if I'm serving the needs of hedge fund, then what does a typical hedge fund use case? They are doing all these liquid strategies. and they're taking exits from these positions, and they want to hold those that in some kind of highly liquid, low risk asset, which is typically fiat or in this case stable coin. But stable coin natively doesn't yield any, or doesn't give you any yield. So what they have, a lot of these hedge funds have done is they hold either Biddles or Benjis, right? So depending on who they prefer, they go for a treasury product that they hold when they're just holding this exit positions in liquid assets. Um, so that's one use case for tokenization. That's where it started, right? After fiat, it was treasuries that started to go kind of that started to grow on chain massively. However, I think if you're thinking about Kamino and Solana, it's a slightly different ballgame. If you look at Solana, the risk-free rate, as we call it, is about 6 to 7%, and the risk-free rate is typically defined by if you went on a lending platform like Kamino on a chain, how much yield can you make on the stablecoin just by lending it out? If it's 6-7%, that's typically a risk-free rate. On ETH, it's slightly lower. We kind of tend to think that is often kind of highly correlated with the chain's inflation, which is kind of in this case, right? I don't have any empirical evidence to prove that. But effectively, the risk-free rate on Solana is at least 300 pips higher than that on Ethereum, which means a treasury product to really kind of take off, if you're offering 3 to 4% on a treasury product and the risk-free rate on a particular chain is 6-7%, people typically don't want to go big on that. However, that is not true for the large hedge funds and the liquid funds. It is definitely true for the retail audience. So if you're really serving the retail audience, you're looking at slightly higher yield products offering you 8, 9, 10% and north of it. And when you're looking at which products can deliver those economics, you're thinking largely two types from what I've seen so far. One is like any kind of options or structured yield products like a basis trade product on Solana, which could offer in the mid to high teens. So that's one product. The other one is typically private credit funds that offer 9, 10, 11, 12%. Of course, with private credit fund, there's a challenge of liquidity, which is you can't just get in and out of it. So there's got to be some kind of secondary market liquidity, or there have to be some solutions around liquidity. But those are the two typical products. There's also, if you look at Solana, we've had a product called Onray, which effectively has tokenized reinsurance yields, and that offers again healthy low two-digit yields. And those are the products that I see kind of taking off in the near term on at least on Solana. So that's kind of the broad strokes, kind of where things are, and maybe just would for your audience's benefit, it really helps understanding who Kamino is. Just a minute of that. We are the largest lending platform on Solana, and we've got over 70% market share of the lending borrowing use case on the chain, over 1.7 million users. And what we typically offer is if you're holding an asset and if you want to typically borrow some stables on that, you can we support most of the primary on-chain assets, and you can come supply your assets as collateral and borrow some stables. So that's the kind of use case, which is why we're discussing these RWAs and all these different things, where we say, okay, can we accept treasuries as collateral? Can we accept private credit funds as collateral? Can we accept reinsurance tokenized as collateral? So that's where all this kind of intel comes from.
So yeah, as you mentioned about the liquidity side of it. So how do you at Kamino manage the liquidity aspect and the risks that come along with it? Like as you mentioned, it's not easy to like put something from a trade fight into the on-chain from a liquidity perspective. So if someone comes with a certain asset, so how do you back it up on-chain and bring the liquidity on-chain?
Absolutely. And before getting into that point, maybe worth spending a minute talking about something else, which has been kind of on my head for some time, which is a lot of firms think that just by tokenizing, you will be able to kind of grow your asset. And for most of the TradFi firms, tokenization is a means to higher or larger AUMs. There are assets who genuinely hop chains just to tap into 10, 20 million of liquidity for their fund, by no kind of genuine qualitative reason for the fund. It is just like hopping, chain hopping for some grants from the foundation,
Just
and
aggregating liquidity
yeah,
somewhere.
so that I'm not going to talk about those funds. I'm just going to talk about the genuine funds that have legs and that want to on chain their value proposition and scale it from there, right? So again, even for those funds, tokenization is just the beginning. You're just getting your product into the on-chain market. There's so much to do to scale your product from that point. And what are the typical things you need to think about? Um, I mean, and this there are, again, here there are multiple. Like if you think about the decision tree, it is quite complex, but I'll try to simplify it for you. So the one set of funds that offer tokenized products, TradFi products, but can offer it in a permissionless way. So Onray is an example that I spoke about. They are permissionless. I think Syrup USDC was another product which was issued by Maple Finance. We have Centrifuge, who are launching some of the TradFi products, CLOs at AAA grade that again have permissionless access to people on chain. So let's talk about this set of yield bearing assets. So when you're launching an asset, typically your first thing you're looking at is, can I offer frictionless user experience for the DeFi audience to insta buy and insta sell, right? So that's one critical use case. And in order to do that, people will have to have a seamless way of minting and redeeming your token, or going to a DEX and swapping for stables. If you're able to provide those two, then you've got a good start. And the minting experience should be seamless, or you should have enough DEX liquidity to support the kind of the purchase of this particular asset. So that you have to have liquidity. And how do you bring this liquidity? You can have proprietary capital that you've raised for this particular launch. The launch is not just about bringing hundreds of or tens of millions of dollars into a particular asset, but also saying, okay, if you have people committing X dollars into this particular initiative, look at it as an initiative rather than just as a product. How do you split it across DEX liquidity? How do you then split it across lending markets liquidity? And how do you then split it across? How do you hold some or a vast majority of it in the fund itself? So it is about just kind of getting that methodology, and often DEX liquidity and lending market liquidity go hand in hand, because if your DEX liquidity is thin, your lending market LTVs are going to be pretty low, because
Yeah.
no lending market is going to give you high LTV for a product that has very
Which
thin
antibody?
DEX liquidity. Exactly, right? So those are all things you've got to think about when you're planning your launch on any chain. It's not just Solana, on any chain. And once you have the user experience on getting in and out of an asset, great. Then the next step is, how do I maximize on the economics? The economics can be maximized by two things. One, you will be able to bring native yield. If your product is like yielding 10-12%, then that's a brilliant start. And then you have something called DeFi offers you a utility called multiply or looping. It's called multiply on Kamino. It's called looping on other platforms. And the general term, DeFi term, is looping. And for a 10-12% yielding product, and with a stable coin leg of about, if someone is able to borrow stable coins at 6-7%, then you have a 500 basis points cap there. So if by looping it, you're able to get that 12% into the 20%. And that starts looking suddenly super cool, right? If you're an investor. So that is really when you start seeing this flywheel effect of all sorts of liquidity flowing in. You start with a bootstrap number, and then you get retail volume really attracted to this whole proposition. And that's really, then it starts scaling from there.
Yeah. I mean, thanks for that very comprehensive explanation on what goes on the background. So, as you mentioned, like there are so many assets looking to go on chain and bank on the trend. So, how do you see the transparency side of it? Like, are there enough tools or checks in the market on chain that can, comprehensively show the end user that yeah, the assets you have been proposed have enough liquidity in the background? I mean, liquidity and transparency have been an issue with stablecoin market as well, where certain stablecoins have been criticized for not showing their what is the backing of the assets they are circulating in the market. So how do you see that case with the new trend of RW tokenization, the
Yeah,
transparency
I
side of
mean, absolutely. I think it is perhaps a little bit more important with RWAs than even with on-chain assets, right? So when you
stablecoins?
have
Yeah.
an on-chain, even a meme coin, right? Meme coin, when you launch a meme coin on a platform, the due diligence on that meme coin, apart from who is issuing it, how concentrated the holding is, and all that, it's all on-chain. The due diligence is perhaps a bit faster than an RWAs because proof of reserve becomes a challenge. Proof of reserve, how do you make sure, and price feeds, how do you make sure price feeds are managed? And it also is important to have real world price feeds really kind of driving LTVs rather than DEX liquidity, because if for some reasons DEX liquidity looks shallow for some reasons, then you don't want to cause liquidations on the lending market because DEX liquidity is shallow. So there's like bunch of different considerations in how we go about managing risk and driving transparency into this market. But typically, the you have to have proof of reserves before onboarding any asset, especially if it is RWAs, because we don't know if there is real assets backing them. One good thing is Chainlink, for instance, who are one of our top partners at Kamino. They have been extremely hands-on with that particular use case. They're kind of market leaders in that space, and we kind of say, okay, hey, make sure you have a Chainlink proof of reserve. So that is something that we do. In terms of ongoing risk management, at least from a Camino perspective, we have something called risk.camino.finance. The link might change, but we have a publicly facing real-time risk dashboard where where anyone can go and check all our positions being sliced across 12 different risk dimensions or risk factors, VAR, sensitivities, and scenario analysis, all done on the fly using on-chain data. I personally don't think there is any other DeFi platform that can do that at this point, so, with that level of
So you
sophistication
have
and
that
transparency.
speed, yeah.
Yeah.
So
So I mean that's been a qualitative aspect of the firm, right from day one. We've when people, I mean, we do talk about high yield products and all that on online as well. But when there is a huge liquidation, we are the first to really kind of, if Bitcoin takes a 10% tumble and the altcoin market takes a 30% tumble, we are the first to be out there effectively just talking about liquidations and risk reports around how liquidations and bots reacted to this particular market incident, and coming out transparently. So these are all things that has to be part of the firm's culture. And it's not just Camino. I think this has to be starting from the issuer to liquidity providers to the curators that we call these days, like the steakhouses and gauntlets of the world, to lending markets and dexes, or lending markets particularly. I think it's important to have everything from proof of reserves to risk management, and again, of course, smart contract audits, because there have been times where we've shied away from launching a particular product, and then a competitor launches it just to get hacked, right? I don't want to name the specific competitor in this instance, but these things have happened because we see some vulnerabilities, we don't touch those products, and it's see, end of the day, we have, particularly in the Solana ecosystem, we've got to where we are post FTX. Many of these firms have survived FTX. They've survived North Korea. They've survived all sorts of difficult market stresses that you can potentially apply to a financial ecosystem at the most nascent stage of their journey. So they are super conscious and super cautious about risk management and compliance when we deal with these products.
Yeah, good to know that you have setting the standard for that. So when we talk about DeFi RWA, where do you see the compliance side of it? Like uh, DeFi by definition should be like decentralized, but for onboarding institutional players, you need some form of safeguards in the form of KYC or AML. So you know those products are not being used, or you can't get under the scanner of regulators for providing something which turns out to be not so regulatory legal. So how do you see the compliance side of it?
Yeah, absolutely. So there are like two ways of thinking about it. One is how we approach any kind of asset onboarding at Kamino, but also how we look at how we see assets evolving. So there are two angles to it. Let me talk about the issuer and the asset angle first. So you see two types of assets. One are permissionless assets, still TradFi RWA assets, but permissionless assets, which means once the product is minted or once the asset is minted, like a stable coin USDC, for instance, it's minted and then market makers take it to the chain, and then from there anyone can buy, sell, and hold it, right? You and I can hold USDC without having to go through any kind of compliance overheads. Uh, Whereas if you want to hold a Biddle or a Benji, you will have to have your KYC. Your wallet has to be whitelisted. You can't just hold it otherwise. So that's two types of assets you typically see, and there is like shades of gray here, which is it's not like black and white. Some assets have gone through the regulatory rigor and they still are very comfortable making it permissionless, whereas others actually have to, like, we are very pedantic about compliance, KYC hurdles, and there's got to be this. Everything has to be permissioned. I mean, when I say everything, I'm not talking about the chain. I'm talking about the asset. So the token at the token level is permission. So that's two aspects. And I think the permissionless. I think we already discussed how we could scale by 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 making the user experience and liquidity healthy. Now, on the permissioned side, the challenge that the whole ecosystem, and that's probably the biggest experiment that's currently happening within the RWA space. The stablecoin, I think that's kind of taken off quite well. Permissionless RWAs, to some extent, I mean, not as well as stablecoin have. It's going to be a journey. It's going to be a multi-year journey for even for the permissionless space to take off. Then you come to the permissioned RWA space. And that is where I think the biggest and the toughest experiment lie. Because even for us, if you think about it, we have about 1.7 million users who are all not KYC at this point. If you want to kind of deal at scale with some of these permissioned asset, then probably the way to do it is a permission environment. And if you're going to convert all these 1.7 million, or try to convert 1.7 million users to permissioned or KYC, not all of them are going to convert. Let's say we hit a 10% success rate. That's 170,000. Can we achieve the same kind of network effect that we've achieved with 1.7 million users through this 170,000 users? That's the biggest experiment, right? So that experiment is what is going to define and drive the future of on-chain permissioned RWA asset space. And then again, that we will probably see the same kind of constructs. You may have DEX and you may have liquidity and all that. There are other liquidity mechanisms that are just kind of starting to show up. We could see all that, but in some sense, what you will start to see is that infrastructure is yet to be built by most DeFi platforms. So that could be the future. We don't know where it lies, how far it lies, and how healthy it is going to look, how big it's going to be. But that will really define how successful other asset classes of RWA uh, have had on chain. So that's broadly it. In terms of Camino itself, we do have a very solid compliance kind of ethos, as I mentioned already, compliance and risk ethos. Especially when it comes to some of the tougher jurisdictions where assets start getting issued, or some of the more rigorous jurisdictions where users come in from to use these assets, we have to be careful about kind of filtering out assets, but also geo-blocking users. Yes, so those kind of due diligence happens, and if we are in doubt, we always have our lawyers that we reach out to saying, hey, we are not sure about this asset because of X, Y, and Z reason. Are we okay to onboard these assets, or are we open to this particular part of the world? Can we open up our offerings to this part of the world? It's always a compliance conversation. Once compliance opens up and they say, yeah, go ahead, then the risk guys get involved, then the tech guys get involved, and then the business and marketing guys get
Yeah,
involved. So it's kind of that's kind of the
cycle.
flow.
Yeah.
Yeah.
I mean, US has definitely taken the lead on the compliance side. I guess they rolled back the DeFi reporting laws earlier, where DeFi platforms by necessity were required to do KYC for all users from certain amount. It was very low, I guess 1,000 or something. So yeah, the Trump administration took it back, and I think the new administration is working towards that. I mean, they are giving the DeFi space a little bit of breathing to ensure that the decentralization side of it remains intact. So hopefully we get, I mean, better compliance in the near future.
Yeah,
So
the
now,
only issue is that with compliance, we cannot hope and we cannot trust one regime and
yes,
put all our eggs in that basket, because then
do that.
if 2028 happens and then if someone like
This change in
Biden
government.
shows up again, then we're all screwed.
Yeah, true that. One should not keep note of that in their mind working in this sector. So, I mean, moving forward, I want to ask about you about what other use cases you see for RWAs apart from tokenization. Like tokenization is kind of the trend right now. Everything is getting on chain, but do you see it evolving into something else in the near future? I mean, there are lending products based on it, but what other factors or products or use cases do you see RWAs evolving in the near future?
Okay, I'm not going to talk about the tokenized cards or Pokemons at this stage, right? I'm not an expert at that. I don't even like, I mean, yeah, the odd indulgences aside, I don't really spend much time on that. So I'm not an authority there. I can talk about my views of how the financial services world, the traditional financial services world, and the DeFi world are coming together, and how I can see that evolving into a future state. Uh, yeah, I think I already mentioned how hedge funds could use treasuries, right? Nice treasuries. I think that's pretty clear. I think what we are going to likely see over the coming years, maybe in the next 10 years, it's going to take a good long time. I hope it's not going to take that long, but I think it will. Um,
Yeah,
what you're going to see is more people are going to bring more assets on chain, and the entry point will be something like a Bitcoin. It's probably going to be Bitcoin or Ethereum or Solana. The top kind of the OG assets will be what large bag holders will hold on day one. But there will always be times when they want to take profits. There will always be times when they are considered risky assets, just like a Nasdaq and Nasdaq is treated. So then they want to then think about, okay, how do I then diversify my exposure on chain? I don't have to on ramp it every time to or off ramp it to fiat. How do I tap into some of these kind of fixed income type products, or how do I kind of ape into some of the or store some of my exits into gold, tokenized gold. So I see that kind of style of management slowly starting to happen. It is going to be a journey, but I think you're going to see portfolio management on chain, very much like what we see with real world asset management today, traditional asset management that we see today. So and in order to do that, we will need to have the whole infrastructure in place, right? So
right.
without the liquidity, I mean, first is without the discovery infrastructure, which is okay. I'm looking for this. How do I find it, right? So that has to be there. There's no discovery infrastructure at the moment. It's all very tribalistic. If I'm a Solana user, I know I'm going to find these options on Kamino, but if I'm not, I'm just trying to look at some on-chain options. What are the options? Even I don't know. I'm very Solana focused. I'm not really looking too much into the options on Ethereum or Base or Arbitrum or Hype, right? So there's got to be some chain agnostic discovery mechanism for investors to kind of look at, okay, what are my options? And then they say, okay, then there has to be some kind of platforms that you're able to say, okay, I have X amount of stables now that I've just exited my Bitcoin position. I want to kind of get yield for the next 10 to 12 months until this turbulence, market turbulence goes off. So I'm going to put this into maybe a private credit fund. I mean, maybe private credit fund is seen as a huge tail risk asset, but maybe something like a treasury asset or a high risk, low, good investment grade CLO, which offers 6, 7, 8%. So it's things like that, right? So that discovery process needs to be that, and I think those kind of mechanisms are going to start to show up very much like they do on Web2 or TradFi today. That when that happens, okay, we've arrived.
Yeah.
Now,
Yeah.
this space is not just about altcoins. It's not just about Bitcoin, Ethereum, altcoins, and meme coins. It offers a much more holistic view of asset management or offering.
Yes.
That's I think is the future.
So I want to know, how do you see the RWA trend going through the bear market? Like every bull cycle, we see a particular trend. Like last year, we had NFTs and we had multiverse and we have metaverse, and so much so that Facebook went out to change its name to Meta and focus whole thing on Meta. But 4 years down the line, there's no one talking about their metaverse or metaverse in general. I mean, there are projects in the background working, but it's not as big a hype as it was last year. Same goes with NFT. So how do you see RWA transitioning through the bear market to the next cycle?
I personally don't see it that way, because to me RWAs actually provide you some cushion through bear market,
Yeah.
right? Because that's kind of the on-chain diversification option for you. So
Yeah.
I
So we
personally
yeah.
think bear market might be better for RWAs. Imagine you're losing 70% on Bitcoin in 2026. Hopefully not, but that's a genuine scenario
Yeah.
that it can happen.
Yeah.
We all know it. Why would you hold your assets in that for that particular year? This happens every year. Just get your exit out in Q1 and then put it into an RWA asset which is offering you 10, 12, and with looping it offers you 20%, and then get back into your Bitcoin by end of
And
2026, early 2010s, and do the right. So I think that you will see that circulation. I think it's very much like it's going to start. This space is going to start learning its cycles and how assets fluctuate through different business cycles, and start managing portfolio, and then RWAs become a core component of these portfolios.
yeah, yeah, that's a good strategy. I mean, not a financial advice, but yeah,
And where
that sounds like something people can experiment with. So yeah, for my final question, I want to ask you about Camino's long-term vision for RWs. Like, right now, it is leading the Solana ecosystem into it, but let's say 5 years down the line, where do you see Camino heading the RWA ecosystem?
Wow, I mean, we don't typically do 5 year plans like that. It's very hard to plan for 5 years in crypto because the narrative keeps changing every 5 days. So, what I can tell you is our focus is on chain credit. We are a credit house, credit shop. So anything and everything we build will be kind of thematically aligned around credit, and that is what we are good at, that is what we've been good at, and that's what people trust us for. We've been in the market for 3 years, and now we see Lindy effect kicking in, which is effectively people trust us. The more we've got 18 smart contract audits successfully done, and we've not had any hacks, touch wood. And that is where we want to kind of play. So yeah, we will be looking at. I think I told you, right. The permission RWA is a space which I think the whole market is trying to crack. So are we. It is going to be a journey, and then of course as we start to scale, and as the market starts to scale towards web 2 and more web 2 interfacing and interactions, I think that could be a potential distribution angle for us as well. But at this point, there is at least, like, I mean, sitting here today, if I wanted to kind of just describe what we want to do in terms of RWAs, I can put a 1 year roadmap in terms of the amount of work that we still need to do. So much to do, just kind of at the infrastructure level, to get us to a say, okay, we are at a stable state for RWAs, like onboarding, KYC, and creating liquidity in that space. it is going to be a big, huge journey that we are working on. So there's like bunch of that's kind of our focus at this point. We're not like thinking too far away into the future. Let's keep us going for the next year with kind of tapping into what is currently really making sense for us and in kind of partnering with TradFi.
Cool. Yeah. I mean, thank you so much for that time of yours and explaining the niches of the RW market, how DeFi works in the background. And hopefully we will get together like some other time with another milestone of Solana, and then we can discuss more about how the ecosystem has evolved from, let's say, now on. So yeah, thank you so much for taking out the time and helping our readers and viewers to understand the evolving RWA market.